Talked about pharma being one of the preferred sectors. What within pharma, because it's a large pool as you look deeper, is it largely the CDMO players that you would stick with?
CDMO is also opportunity. Even domestic our formulation business is doing well. Generic is another opportunity. That's why I said, irrespective of the tariff, US cannot afford. So I think I will look for a combination rather than just looking at one, because you have to a bit diversified portfolio, because the day you get a tariff news, some of stocks can even correct 5-6%. They can have a gap down opening. But I think opportunity. I see what is very important. I want to highlight about tariff. The tariff drama is going on right from January. Okay. Now, what we have to understand in a very mature manner, whether it is up to what extent is priced in. So it's now the tariff or the polity risk, which we were talking in January. It's no more unknown risk. It's a perceived risk now. What is very important to understand, and without getting into too much noise which is there in the system right now, we have to really sit down and analyze whether it's factor or not. We think up to large extent this noises has factored, and that's the reason global market has corrected post tariff related challenges. So I think it is factored in, maybe 60-70%, maybe 10-20%, 30% correction can happen depending on which stock and which sector you see a bigger impact. But largely it has been factored, at least from India perspective.
Right. Sandeep, you also talked about infrastructure and materials as a segment. What gives you conviction about this space making a comeback? Is it cheap valuations, or do you think the government spending is going to kick in once again?
So I think, yes, valuations have again been attractive. And if I have to look at India from a longer term perspective, India is one of the fastest growing economy in the world. And I'm not looking for just next 6 months perspective. If I look at for next few decades perspective, I think it's a great opportunity. And every forum, when you interact with the bureaucrats or listen to the policymakers, I think somewhere we expect, nobody has quantified or put in a timeline, this is what they're going to do, whether it's state government also. When you interact, you get a fairly good perspective. They are committed. I think it's a question of time. Budget has also endorsed up to that extent. A lot of people have given up, but I think a lot of stuff is happening, and I think we have to look at in a collective manner. See, it's a very human psyche, when market is going rallying, all negative news are actually ignored, and similarly when market corrects, even positive news are getting ignored. So I think we have to really sit down and analyze and try to see what is narrative and what is reality. Reality is that governments is committed, state governments are committed, large corporate houses are committed. So look for opportunity rather than saying that slowdown is there across the board. Let's say example, we own a lot of hotel stocks. Yes, consumption is not there, but hotels numbers are extremely good. So I'm saying, looking at, you have to identify such sector and such opportunity. And every crisis brings some opportunity. And don't look at the short-term pain for a quarter or 2 quarters, you might be visible. Ultimately, if we believe India long-term story, and I'm a pretty convinced from a longer-term perspective that something has changed for India. India Perception Analytics is also endorsing a secular bull run sort of thing, or a larger thesis is very constructive. Then I will look for opportunity. I think market has corrected. Maybe overheated correction we have seen. Certain hype was there in certain some of the, let's say, private side of the market, the SMEs also, some of the mid and small segment also. I think we have seen good correction, and I said that avoid all those names which have seen good amount of hype and they were trading in the admire zone. I think those are the names if you can avoid, and many names are available in the deep value situation, and which includes mid, small, mid also, small also, and large also in a big way. So I think it's a stock specific opportunity you have to identify and try to psychologically remove this pain which we are seeing right now. It's not people say, let market settle down, then I will buy. I already have enough exposure. You may not get it at that particular price. So whenever you are getting opportunity, and if you have cash levels and you have a really liking for or risk appetite for Indian equities, which a lot of people had at the peak of the cycle, I think we should remove these noises or narrative which is there in the market from a very near-term perspective. I think let's look at stock-specific approach, and maybe 2025 will be far, December 2025 will be far better than what we are seeing currently.
All right, let's hope for that. But Sandeep, also share your thoughts for the energy sector as well, because you believe that energy could be the big theme for the next decade. And given this correction, what are your latest thoughts within the energy basket?
So I think energy is a decadal call. We are not looking at from this 1 or 2 years perspective, whether talk about renewable side also, I think when we said that India could be self-sufficient by 2032, 33 sort of thing. I'm taking the conservative manner, not by 2030. So even you take very conservative approach by 2033, then any companies are, which is part of the renewable basket or putting efforts in the new energy space, I think those are the names, and they're talking about very sizable opportunities. So we are not talking about small players, and even Thermal also we remain optimistic. Distribution companies we remain optimistic. This whole space is very constructive, irrespective of the noise in the market. I think earnings momentum will continue out here. Okay, and let's not forget about a month or so, particular prices as this month was slightly weak. But if I have to look at the 10 years perspective, next 5 years perspective, this is the area where we have large holding, and it's a very focused approach. These are like core holdings from a decadal perspective. So we remain very constructive. In fact, we have been a buyer whenever we are getting opportunity in these names.
Sandeep, I also want to talk about, PSUs at large with you. I know the rationale now in the market, or the reworked rationale, I should say, is that don't look at umbrella strategy. You've got to go deep down, look at individual stocks. But what about the erstwhile PSU darlings, your defense, your railway names? Do you think they will also show some signs of leadership? And are they looking attractive right now? Because the first correction actually creeped into these sectors.
So let's understand the thesis of a PSU from a larger perspective. So when we as a house say that this decade belongs to value, okay? And obviously PSU fits very well in that larger thesis. But you also keep in mind, PSU stocks have high beta, okay? And this is the one area where a lot of people have ignored. And by end of 2024, or let's say by mid of 2024, we have seen some sort of hype getting built in defense, railway, and many more such names were there in defense and railway particularly, and even some of the logistic names. So we have seen some amount of extreme euphoric move happening in some of these names. And so it's a very natural that they have corrected. I think correction is also quite meaningful now. If you personally ask me, we as a house believe that opportunity has come to rebuild PSU exposure, which we have started doing very selectively. We are buyer in PSU names also. See, again, when there was signs of euphoria, we actually cut our exposure. Now we are rebuilding our exposure, keeping in mind the valuation is great. See, the good part about PSU is that liquidity is amazing. Okay, they are fairly liquid names. So the big challenge which we generally market is facing right now is about the impact cost. The impact cost of the PSU stocks are still on the lower side. You can get exit and entry if you want to buy 50 lakh shares or 1 crore share or some of these names. It's very easy to do that because liquidity is pretty high. So this is one important criteria, I think, which now market will start recognizing, that you have to have your liquid stocks in your portfolio irrespective of the valuation. So because for whatever reason, if you face any redemptions or you face any challenges or you want to do sector rotation or stock rotation, you will not able to do it if these names are illiquid. So from the liquidity perspective, impact cost perspective, PSU actually is the right tick box for us. And valuations has corrected a lot. So I think I'm a larger thesis. I still remain equally constructive on PSU because I always said that it's a decadal call. It's not a call which you say for the next 2 years, 3 years perspective. And now time is right to rebuild your exposure selectively. Even in the PSU space, one can do that. And this is something what we are doing right now.
Interesting. So, Sandeep, if an investor comes to you right now and wants to invest purely in mutual funds and has managed to time the market, is sitting on a pile of cash with a medium risk appetite, what kind of mutual fund portfolio would you construct for them?
See, we generally advise when environment becomes difficult, let's say largely a risk-off phase in the market, which is very difficult to navigate for most of the people, the best strategy is to go for flexi cap type of funds because a money manager get highest amount of flexibility. These things, depending on the opportunity to shift from small and mid to large or large and mid to small. So that's flexibility the money manager has. That's the one of the reason we believe that the flexi caps are good. Or if risk appetite of particular investor is on the lower side, then we can go for hybrid schemes also, and particularly the multi-asset side because you do get diversification and not only from the equities perspective, more from the asset class perspective. Again, a very flexible product where money manager has a lot of flexibility to rotate not only stocks, but the sector itself, or but the asset class itself. So I think these are the two names. For a conservative, I will say multi-asset, and somebody has a high risk appetite should go for flexi in this difficult and challenging environment where instead of you choosing mid or small or large, okay, an environment changes, let's say down the line 2 months or 3 months, okay, and you may not able to flip or rotate your portfolio up to that extent the way money manager can do it, because this is our full-time job. So it's better to go with this approach rather than getting into a thematic. See, if you really look at the peak of the cycle in September, October, we have seen gush of liquidity coming towards thematic funds. Okay, and thematic funds being from the same industry, and we can say that the thematic funds obviously are more risky and more concentrated. But whenever risk appetite is high, you saw the maximum liquidity. That itself is a sign, and many investors are now stuck with the thematic funds. So I will still not advise that one should venture into any thematic fund at this stage. It's more of a flexi cap or multi-asset approach will yield better returns.
Interesting. Sandeep, Jan, when we spoke, your investment philosophy was stay active and an absolute focus on returns. I'm sure you've tweaked that narrative now.
So, Sisha, we have to practice, we can talk about it, but ultimately we have to demonstrate it. A lot of people are saying, I'm extremely negative and mid and small and other things, the narrative we keep on hearing in the media. But ultimately, you have to demonstrate in your portfolio. Right from July, when we said it's a risk off, we actually moved out from mid and small to large and mega large. We moved out from high beta to low beta and from high illiquid to liquid. We demonstrated we underperformed also because markets mid and small rallied till September, and some of the stocks even rallied till December also. So it's all about, see, theoretically, a lot of things looks very nice, but ultimately we have to demonstrate in your action. And that's the reason as a quant, we talk about a dynamic style of money management based on the risk on risk of environment. We have to be early. See, the risk is all about you have to be early in the taking a risk call rather than be late on that part. If you have to be ahead of the curve in taking a risk call. So risk is very important for us and something we actually practice. It's not about just talking about it, that this is what we do. We actually demonstrate it. And sometimes underperformance is a part of a strategy. You have to live with that thesis because every sector, every quarter, every year, every month, you cannot be leading the chart. So this is something a lot of people, people look at absolute return, people look at relative return. I always say, please look at risk-adjusted return. What risk somebody is taking to generate this risk? And that is our focus area. Risk-adjusted return is the right measure, and most of the time it remains nicely on the Excel sheet. Even best of the wealth manager don't talk about it. People just talked about underperformance part, on relative underperformance and absolute returns. So I think that approach has to change. Once you start accepting the risk-adjusted returns approach, you will be more satisfied investor.
That's so true. And Sandeep, such great learning today talking to you. Thank you so much for your time.
Yeah, thanks a lot for inviting us.
Okay, words of wisdom, words of advice and strategies coming in from Sandeep Tandon from Quant Mutual Fund.
If you like this video, then like, share and subscribe to ET Now. If you like this video, then like, share and subscribe to ET Now. If you like this video, then like, share and subscribe to ET Now.